Hello, and welcome to the Individual Investor Show. My name is Jenna Brashear, your host for this evening. I hope you had a wonderful Halloween weekend spending time with friends and family, trick or treating, carving pumpkins, or watching spooky Halloween movies. We are so excited to bring you yet another II show. Tonight's event is the Individual Investor Show Inside the Investor Minds of Chris Pedersen and Robert Hagstrom. I want to preface tonight's event by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with every broadcast and article is to educate you on how to make better financial decisions. I just want to mention that we are overjoyed by how many people attended our last II show, and as always, we appreciate the support. If you have any questions for me or suggestions about upcoming topics for the show, feel free to reach out via the comment section below. For this week's show, we had the pleasure of sitting down with Chris Pedersen and Robert Hagstrom, two influential authors and investment experts. Our interviewer, Charles Rotblut, asked Pedersen about his new book, Two Funds for Life, as well as questions on cash contributions, target date funds, backtesting, and philosophical investment advice. In our chat with Robert Hagstrom about his new book, Warren Buffett Inside the Ultimate Money Mind, Hagstrom discusses how writing about Buffett influenced his own investment process, key factors that go into choosing a business to invest in, and if mimicking Buffett is beneficial or detrimental. So, without further ado, sit back, relax, and enjoy our presentation. Take it away, Charles.
So I'll know that. Okay. Thanks for joining us, Chris. You wrote about contributions about from the standpoint of monthly, quarterly, or one-time, quote unquote, lump sum intervals in terms of investing the cash at those different intervals. But it ties in, and I know you looked at it from the standpoint of saving for retirement. But a question I get, you've probably had it too, is from someone who's sat on the sidelines. I have this cash and I want to get back in. What's the best way to do it? And could you say what you found out when you looked about as spreading over monthly, quarterly, or yearly, or doing it once, what you found out in terms of the impact on portfolio growth and returns?
Sure. The expected return that you'll get is highest if you invest it all right away. The risk that you enable is highest if you will invest it all right away. That's the gist of what you learn when you do these back tests and analysis. So from a behavioral standpoint, if you're really concerned that you're going to have this deep regret that you've invested it all and the market drops the following day, dollar cost averaging or investing slowly over time is a great way to address that concern. And you can decide whether you're going to invest it daily for a month to get it all in, or monthly for a year, or quarterly for 3 years. The longer it takes you to get it in, the lower your expected return, but also the lower your risk. It's a form of diversification. It's time diversification is what you're doing, and that's why it lowers the risk. This shows up in a really meaningful way for young investors who are for the most part, young investors can't do the lump sum investment. But if they could, if their whole life savings came to them all at once, the next day they would be exposed to the full potential downturn of the market. If we had a crash like in 1987, they would see a huge loss in their portfolio, and it would probably rack their emotions, and it might ruin them as an investor for life. If, on the other hand, though, like most investors, they're getting the money on a monthly basis and they're investing it, they may not even notice a lot of market downturns because the cash flow is going to smooth the ride, and they're going to see much, much smaller downturns for the first 10 years, 10, 15 years that they're investing. In fact, most young investors starting with zero and doing regular investments will see smaller downturns or smaller drawdowns in their account, declines in the balance of their account, than they will see with a conservative target date fund at retirement. So that smoothing is a really powerful tool to help avoid what might be an intolerable risk for a lot of people.
Interesting. And then in terms of target date funds, obviously, as you know, they're the default option in many retirement plans. Any suggestions about how someone might go about choosing one, particularly their retirement date's not certain, or they're falling in between those 5 or 10 year windows? some of those funds are actually dated?
Yeah. So usually the default and the fund family aren't going to be things somebody has a lot of choice about. The default will probably be the fund year that's closest to the year in which somebody turns 65 years old, because that's generally perceived to be when they're likely to retire. And there's nothing wrong with that. In fact, if it nudges people to get investing earlier, all the better. And most of the evidence is that it does. And not only does it get them investing earlier, but it also gets them investing more in equities earlier, which are just fantastic benefits to a young investor. If somebody wants to second guess the choice within fund years, if they invest in a fund that's a little bit farther out in time, say they're like right in the middle between 2-year choices, if they invest in one that's farther out in time, their portfolio will be managed a little bit more aggressively. If they choose the one that's a little bit nearer in time, their portfolio will be managed a little less aggressively, but not until they're within 20 years, 25 years of retirement. So for a young investor, it doesn't matter. It will make zero difference. As somebody's getting closer to retirement, that choice starts to make a small difference, but it's a small difference. Yeah.
And you use a lot of back testing in your book to test strategies. Could you give us, and I know it's probably a lengthy answer, but perhaps condense it a little bit, the argument why back testing is actually really helpful, and then some of the pitfalls of relying on it?
Sure. All we have in terms of understanding the future is the past. It's true in investing. It's true in life. We assume the sun will come up tomorrow because it came up yesterday, and we know a little bit about the physics, and we assume that they're going to continue and the rules won't change. All we know about the future in investing comes from studying the past. And so if we look back and we see patterns that happened in the past over many, many different time periods, that suggests that they'll probably happen in the future. And if we see patterns that happen rarely, then that suggests they probably won't happen in the future. So when we do our back testing, we're not looking for very tiny differences that only happened 50% of the time. We're looking for things that happened over 90% of 600 different time periods. And how do you get 600 different time periods? You take 50 years and you use every month as a different start date, and then you loop at the end. And so that means you go from, in our case with our back testing, from 2021 or 2020 to 1970. And everybody goes, whoa, wait a minute. Nobody says that 2021 is going to look like 1970, and it didn't. And that's true. But if you don't do that, if you don't make at least one small assumption like that, you end up overweighting the years that are in the middle, because you can start in, at the beginning, and then when you start running out of years, you've sampled the middle twice. So no back testing is going to be perfect. The same thing is true of Monte Carlo, though. It's not perfect either. Monte Carlo simulations make a bunch of assumptions. They assume that either any year can be followed by any other year, or that you'll always bootstrap by 0 to 20 years. And so Monte Carlo simulations end up having less reversion to the mean than we actually see in the historical data. So all of these are like fuzzy, imperfect crystal balls. But when you're trying to figure out what to do, you need something. And this is the best data that we have. So I think the fact that most of the strategies that if not all of the strategies that we recommend, are backed up by a preponderance of historical behavior that says it will benefit you, should give people comfort in following it.
Great. And finally, in your book, and I'll let our listeners know, we'll have a link to it in the show notes. You highlighted a lot of long-lived animals and plants, from trees to reptiles. Is there a particular reason why you chose to include those in a book about investing for retirement?
Very much so. The title of the book is Two Funds for Life. And I really wanted to step out of investing at the beginning of every chapter and have people remember that the reason we invest is to live. We don't live to invest. The reason we're doing all of this, the reason we study it all, is to improve our lives, to make us financially secure for a longer period of time. And I think it's kind of a mental break when you're reading the book to step out and think about a different topic or a different subject. And I love that it was a chance to highlight my daughter's artwork too. She did the artwork, and I think she's an amazing artist, and she has a love of life, and it really shows through in her work. And it helped elevate my writing because it made me remember why I was doing it. It's not just to make money, it's to help people live better lives and have more time to enjoy the life they live.
Great. Thank you, Chris. So Robert, you've written several books about Warren Buffett over the years. What have you, how has writing about him changed your process or how you view investing?
Well, my mother used to tell me, if you write it down, you won't forget it. I guess the one thing about writing books about Warren Buffett is that when you actually go through writing a book about Warren Buffett, his lessons and his examples are indelibly imprinted on your brain, and it becomes a part of your psyche each and every day. So without a doubt, as Warren said, the secret to success is, picking the right heroes. And I was fortunate enough when I started out as a broker at Legg Mason in 1984, that part of our training was reading a Berkshire Hathaway annual report. And so he was my hero. He was the guy that I was going to follow. And having followed him in my earliest career, and now, can you believe it? Not 25 years later, almost 35 years later, still following him. It has undoubtedly been one of the great sources of my success, in addition to people like Bill Miller that I've worked with. But other fact that he has been the cornerstone of how to think about investing was the best thing that ever happened to me.
Great. And then you obviously referenced Philip Fisher in your book and had a big influence on Warren Buffett. But Fisher, in his book on common stocks and uncommon profits, devote a whole chapter to what people should ask when looking at a business. For an individual investor who can't get as close as Fisher suggests, are there some key things people should look at, if just doing a high-level overview to decide, this stock deserves a closer look?
Yeah, well, I thank you for bringing up Phil Fisher. I think Phil Fisher has always been underappreciated as to his contribution to Warren. I think Warren said in the 1960s, after he had met Phil Fisher and after his book had come out, that he'd gone to meet Phil Fisher and found him to be, a wonderful individual. And he said, I think he said, I'm 85% Ben Graham, 15% Phil Fisher. I think if you ask him today, he'd probably say it's either 50-50 or greater on Phil Fisher and Ben Graham, because the lessons that he took from Ben Graham were now, how to think about the markets independent of your business and how to calculate the margin of safety. Those are the two important lessons that Warren took from Ben Graham. But the lessons from Phil Fisher about how to think about businesses, has been everlasting. And so if you go through Phil Fisher's book, and it's still a great read today, he has a list, 13 questions, that you need to be asking people. And we tease them out in the Warren Buffett way. We kind of organize them a little more simply into 4 categories. We want to understand the questions we need to think about businesses. Do you understand it? Really, do you understand what this business does? Is it simple enough for you to figure out? Does it have a favorable long-term prospects, and does it have somewhat of a consistent operating history? Those are questions you need to ask. We think about management, because management's allocating our capital. How do they think about allocating capital? Are they truthful and forward in their communications? Do they admit failure as well as success? These are things that we want to know. What were the mistakes that you made? I don't want to read from a CEO that he's done everything perfectly, because no CEO has done everything perfectly. Tell me about what we missed. What were the failures? And then in the financial tenets, we're looking obviously at cash. We talked about, cash earnings as opposed to reported EPS. We're thinking about return on equity. He had a great, Warren still had a great way in which to measure a company's ability to increase intrinsic value. You said for every dollar the company retains, so for every dollar the company put back into every dollar the management put back into the company, the reinvestment of the dollar, did it create at least $1 in market value? You can do that calculation. And what you'll find is the high returning on capital businesses return multiple dollars for every dollar invested in the business. So that's a wonderful way to think about it. And then valuation. At the end of the day, we've got to figure out what this thing's worth. You've got to get the cash. You've got to discount that cash to come up with an approximate value. Once again, don't be so obsessed in trying to get it down to the last decimal. Nobody knows what the value of a business is today because the future is so uncertain, but you have a cone of uncertainty that you can work within that gives you an approximation of the business is worth this. If it's okay, it's worth a little bit more if things go well, and it's worth a lot more if things go really, really well. Well, those are all your potential outcomes, and you get a central tendency of value. And that's an approximation, just an approximation of what you think it's worth. But the trick is, Charles, as Warren points out, is to buy these approximations at a discount. Be a value investor, no matter if it's a growth company, a value company, if it's rapidly growing, if it's slowly growing, whatever you're buying, buy it at a discount to your calculation of value.
Great. And one final question. A lot of investors, instead of buying Berkshire Hathaway or funds or shares managed by other famous investors, they tend to try and mimic the trades.
Yeah.
Any thoughts on that?
Yeah, I've seen it done a lot of different ways. I'll give you a story. When we were at Lake Mason in the early days, we had what was called the Thanksgiving list, and it was a research list that came out the day before Thanksgiving on Wednesday, and it was the 12 stocks that we thought were going to do pretty well over the coming year, and the track record ended up being really quite spectacular and led to the genesis of the Lake Mason Value Trust. But the entire list did well. What the problem was, Charles, is that people would cherry pick the list. They'd say, well, I don't like that stock. It's not going to do very well. Banks are really out of favor now. And they would cherry pick the list. And so they buy just a few of the stocks, and their returns were nowhere near the Thanksgiving list. What I've seen people do in the past is that they cherry pick Warren, and they cherry pick, well, I don't like this, but I like that. And so they cherry pick, and they don't understand that Warren's success is the amalgamation. It is all his bets put together, and that people try to cherry pick it obviously are making mistakes from a behavioral aspect. Sometimes they want to buy Warren's picks when they're going up, but they don't want to buy his picks that are going down. And it's oftentimes the ones that are going down have the highest future expected rate of return. So if you're going to mimic Warren, I wouldn't cherry pick him. I'd just buy his collection. And if you bought the collection of the portfolio in the same way, and that's the way you wanted to run your individual portfolio, you could do a lot worse.
Great. Thank you so much.
Yeah.
Appreciate it.
As always, we hope you enjoyed tonight's broadcast. Please remember to click the subscribe button if you'd like to be alerted of future II shows. Remember to check out our website for helpful investment resources on our Education Hub. Lastly, if you'd like to become an AAII member, we offer a variety of services that can help you become a well-informed individual investor. Visit AAII.com to learn more. If you'd like to catch a replay of tonight's broadcast, you can visit our YouTube channel tomorrow afternoon. And if you'd like to register for upcoming webinars, visit AAII.com/webinars.
And now a word from our friends at Discover Bank, sponsor of the Individual Investor Show and AAII webinars. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner, Discover Bank, on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Please take a look.
One of the many benefits of becoming an AAII member is getting access to our monthly investment journal. For over 40 years, we've compiled a stream of insights and ideas to help our members become well-informed individual investors. Unlike other publications, the AAII Journal provides investors with unbiased educational material free of cluttered advertising. If you'd like to learn more about Robert Hagstrom's research on Warren Buffett and his findings on value investing, you can check out his new article in the November issue of the AAII Journal. We will include links to his article in the YouTube description below. And with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and take care.